Welcome to another clip here on my YouTube channel. Today let's speak about the currency pair Euro versus the Great British Pound. So the Euro GBP, and that's one of the most liquid crosses regarding all these kind of daily turnovers from the Bank of International Settlement. So let's see what is going on with chart technical stuff and on top some fundamentals. But before we get into more details, I'd like to simply invite you to subscribe that channel. It's quite easy just to press the red button here at the YouTube platform. And of course, I would like to invite you to leave some thumbs up. Very much appreciated if you do so. All right, let's check out the chart technical stuff right now. All right, let's have a look at the chart technical picture. As you can see, that's a Euro GBP, and we are on a daily basis. So we have a Fibonacci analysis, and the first point, the 100% point, is from March 7, which is the low of 082.21.5, and that one goes up to the March 17 high at 084.58.5. So these two levels combined, as usually you see the Fibonacci retracements or the levels and some current levels, and the weekend close word has been something around 083.28. Testing the 38.02 level here, as you can see that in that little needle, and we'll check out the level of the 61.8, which is at 083.12, and going down to that 76.4 Fibonacci retracement at the level at 082.77.4. So a possible target to the downside could be something like these two levels down here. You see the projection levels from 081.57, 081.31. So these 127.2 and 138.2 levels, and especially on top of that for a longer term view into the next 1-2 months to come, something like a target for the bears. For the Euro bears and the pound bulls, it's 080.75, which is something like a 161.80 projection level. You see two lines here to the upside, these blue and red lines, so exponential moving averages. The blue one is the exponential moving average 100, as you can see in the legend here, and the 200 in the red one, the legend right here. On top of that, you see the relative strength index, which is the weekend close at 40. Let's say directly, the weekend close at 45.35. So neutral territory, nothing to say about that. And you see that white lines is a trend channel. As you see, this is kind of a break to the downside. If we break that level, could be something like more speed to the downside to retest these old lows of 082.21.5. All right, folks, let's get into some fundamentals. So first of all, if you like to check out a bit more than just slice data, you will find a lot of stuff at the website of the Bank of England. And especially when it comes to the current situation and the current forecast for the British GDP, for the British unemployment rate, for the British data in a general, you might be just reading that stuff from the last rate decision. So for May 5, the Bank of England simply hiked to 0.75%. So the rest of the year could be something like 1.25% and 1.5%, up to 2%. So the Bank of England minutes, so the protocol from the last decision, speaks about that markets are pricing in something like even close to 2% of a rate. So this is something very, very different if you just compare that with the ECB rate from now on and from the foreseeable future. So it looks like the scissors, the interest rate scissors, are absolutely going into a profitable direction for the pound. And it looks like it keeps being that way the next, let's say, 3 to 6 months or even longer. Regarding all this kind of inflation debate, we got the same stuff facing the Eurozone, the US, and on top of that, like this case here, Great Britain as well. So check out inflation data. inflation data is about 6.5% regarding CPI. If you just take the CPIH, so the harmonized stuff, you'll be at 5.5%. That's the February data on a 12-month basis. So that's quite high. And if you just compare that with historical levels, you will see that this is something like the 6.2% CPI data is something like high than from the 90s. So the last numbers we saw that at 1992 March at the same levels. So a long time. And regarding the CPIH numbers, it's something like the biggest numbers since data from the ONS, from the Office of National Statistics, began. So this is quite a problem, and the Bank of England needs to do something. And the more they do that, and the more they hike, and the earlier they hike, if you could just compare that directly with the Eurozone, with the ECB, the more of an advantage they simply have for the British pound. And we are talking about one effect of currency trading. Markets and the capital is going the direction where it gets a little bit more interest rate and it gets a little bit more security. And I think twice both is served by the Bank of England and with the British pound right now, if you just compare directly with the euro. Just because of the reason, first of all, high interest rates, and if you compare that with the current inflation rates, lower negative yield. So the thing is, if you just park money in the UK, you have less problems than parking money in the Eurozone. So just saying from that kind of a perspective. Check out a couple of other data, not only inflation rates, not only inflation data. Check out producer prices, check out all the kind of pressure from the markets. And of course, the UK is simply in the same position like the Eurozone. High energy prices are causing the high inflation, high producer prices in the second round, and possibly being pushed to the consumer as well. Wheat prices, corn prices, all that kind of prices, same problem in the UK, of course, and all pushing up inflation more into the next 2 or 3 months to come, because the current data from February is not even the data included with all this Russian-Ukrainian war stuff and the cause of the higher, even more higher energy prices and oil prices. So the Bank of England expects the inflation rate to peak something around 7.5%. That's what they said the last meeting. So let's see if that is about to happen, and let's see if that really has the possibilities to dive back into quite reasonable levels around the 4.5%, like a couple of forecasts said. This could be the reason because of a lower energy energy usage, just especially because of oil, heating oil and gas. So that could be because the warmer it gets, the less energy, the less oil, the less gas you usually use. So that's a problem. So that's the most of the problem of high inflation rates, energy.